Good morning, afternoon, evening. Good day to all. It's been a minute, and if you woke up today feeling like the market punched you in the face, you're not alone. Bitcoin broke levels people swore would hold. Altcoins didn't just dip, they folded, and the fear and greed index didn't blink. It collapsed. This wasn't a random move, it wasn't a glitch, and it definitely wasn't just crypto being crypto. What we saw over the weekend was stress. Real stress, moving through a system that had grown a little too confident. Leverage stacked on leverage. Macro pressure got louder. Policy clarity disappeared right when markets needed it most. And when that happens, the market does exactly what it's designed to do. It tests assumptions. Today's show is longer than usual because it needs to be. We're not here to hype rebounds, predict bottoms, or sell you comfort. We're here to explain what broke, why it broke, and what actually matters next. No screaming, no hopium, no doom. Just structure, context, and logic, while everyone else is busy refreshing charts. Let's get into it.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, let's ground this in numbers. After a brutal weekend sell-off, markets are attempting something that looks like stabilization. Not a rally, a pause. Bitcoin is trading in the 78,000 to 78.5 range this morning. That's a modest bounce from weekend lows near 75,000. But let's be very clear. This is relief, not resolution. Volume tells the real story. 24-hour BTC volume surged to roughly $81 to $82 billion, which confirms this wasn't thin trading or a quiet drift lower. This was real participation, forced and voluntary. Market cap sits around 1.56 to 1.57 trillion, down meaningfully from January highs. Bitcoin survived the weekend, but it did not escape damage. Ethereum is holding near 2340 to 2350. That's resilience, but within context. ETH continues to benefit from staking lockups, layer 2 activity, and reduced speculative froth compared to smaller alts. Volume remains elevated, anywhere from 27 to mid 50 billion depending on venue, which tells us institutions are still engaged, not abandoning ship. Ethereum bent, it did not break. XRP is hovering near 164 to 165. Relative strength stands out here. Volume remains healthy, 5.5 to 6 billion, and ETF-related narratives continue to support interest. Still, XRP is well off prior peaks, and momentum remains fragile, strong, but not immune. Solana is trading around 104 to 105. After being hit hard during the liquidation cascade, Sol is bouncing, helped by DEX volume, persistent on-chain activity, and yes, meme coin degeneracy refusing to die. That doesn't mean trend reversal, it means ecosystem gravity is still there. Bitcoin dominance is the quiet headline, currently sitting around 59%, ticking slightly higher. That tells us exactly what this market is doing. When fear rises, capital runs uphill. Bitcoin absorbs risk. Altcoins bleed faster. This is classic risk-off behavior, not a new regime. And then there's sentiment. The crypto fear and greed index is sitting between 14 and 18. That's extreme fear. Historically, these readings don't last forever, but they also don't mark bottoms by themselves. Extreme fear is a condition, not a signal. Put it together. Prices bounced, but structure is damaged. Volume confirms stress, not apathy. Dominance rising confirms risk off. Also, sentiment confirms capitulation pressure, not relief. This is a market catching its breath after being punched, not celebrating survival, just making sure it can still stand. With that context, let's move into our first story, because Bitcoin didn't just dip, it broke key levels, and what followed was the deepest drawdown of winter season so far. We'll be right back.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, welcome back, everyone. Let's start with the story that basically punched crypto in the mouth over the weekend. Bitcoin just suffered its sharpest sell-off of 2026 so far, crashing from the low 90,000s to lows around $76,000, briefly printing as low as $75,709 on some exchanges. This wasn't a slow bleed. This was a trap door. So, what happened? Over the weekend into early Monday, Bitcoin dropped 10 to 15% in a matter of hours, triggering a cascade of forced liquidations across every major exchange. Thin weekend liquidity did what it always does. It turned selling pressure into an avalanche. More than $679 million in Bitcoin-specific leveraged positions were liquidated in a single wave. Not altcoins, not memes, Bitcoin. That erased most of the gains Bitcoin had made in 2026, dragging price back to levels not seen since April of last year. And who got hit? The pain was democratic. Retail traders running high leverage got wiped. Institutions running directional bets got clipped, and a few very loud whales got absolutely nuked. One of the most visible casualties was the pseudonymous trader known as Maki Brother, a whale famous for oversized public leverage plays. This time, fully liquidated, millions gone. Meanwhile, the liquidation engines on Binance, Bybit, and Coinbase were working overtime as stop losses and margin calls stacked on top of each other. Asia, particularly South Korea's high-leverage markets, amplified the move. U.S. markets added pressure through ETF redemptions. It was global and fast. So why did this happen? This crash wasn't random. It was structural. First, over-leveraging. Crypto's leverage ratio had crept up to 0.16, a multi-month high. That's dry tinder. Second, exhausted demand. The early 2026 rally, fueled by corporate accumulation and post-holiday optimism, started running out of new buyers. Once Bitcoin failed to hold $90,000, algorithms and momentum traders got the same message at the same time. This rally is tired. Third, macro bleed-through. Tariff threats, shutdown uncertainty, and global risk-off sentiment didn't help. When traditional markets wobble, crypto still feels it, especially on weekends when liquidity disappears. And once selling started, liquidations became the selling. This wasn't panic, it was math. Now here's the part that never fails to show up. While traders were getting wiped, corporations were buying. MicroStrategy stepped in during the chaos, adding to its already massive Bitcoin stack. Michael Saylor didn't blink. This is the recurring pattern of every major Bitcoin drawdown. Leverage blows up, we can sell, strong balance sheets accumulate. Same movie, new year. So, what market signals saying right now? Options markets are flashing warning lights. Put open interest below $75,000 has surged, now rivaling call interest at $100,000. Translation? The market is actively hedging for more downside. Some analysts are now openly talking about a multi-month consolidation if the $75,000 to $78,000 zone fails to hold. Short-term volatility is not done with us yet. So here's the fork in the road. On the bearish side, a break below $75,000 could open the door to deeper retracements. Macro headlines remain unresolved, and liquidity conditions are still fragile. But on the bullish side, on-chain data shows whale accumulation increasing. Addresses holding 1,000 plus BTC are rising, and RSI is deeply oversold, around 25. That's historically the zone where fear peaks and long-term positioning begins. If regulatory clarity, especially something like momentum around the Clarity Act, materializes later this year, this entire move could end up being labeled exactly the same way every past one was. A brutal shakeout before continuation. So the takeaway? This wasn't the end of Bitcoin, but it was a reminder. Leverage doesn't care about conviction. Thin liquidity doesn't care about narratives. And markets don't move politely just because it's a new year. Bitcoin didn't break because of weakness. It broke because too many people were leaning the same way, and the market corrected them. When we come back, we're going to zoom out from Bitcoin's price and look at the wreckage underneath it, the forced liquidations, the leverage unwind, and the billions that vanished in hours. Because this move wasn't just about fear, it was about structure breaking under pressure. That's next. Stay with us.
Some mornings start quiet. No rush, no noise. Just good people and the decision to roll forward.
All right, welcome back. If Bitcoin breaking below 80,000 was the headline, this was the damage underneath it. What we just witnessed was one of the largest liquidation events since late 2025, with total crypto liquidations exploding to somewhere between $1.7 and $2.2 billion in roughly 24 hours. And no, that's not a typo. As prices slid over the weekend, leveraged positions didn't unwind, they snapped. Across centralized exchanges, liquidation engines went into full execution mode. At the peak, ETH alone saw roughly $960 million liquidated SOL, followed with around $168 million. And the rest came from altcoins and meme coins amplifying the damage. In total, more than 335,000 traders were forcibly closed out, not exited, not stopped out, liquidated. The overwhelming majority were retail traders running leverage on platforms like Binance, Bybit, and OKX. Average leverage, 5 to 10 times. But some traders were running 50, 80, even 100 times leverage. Those positions don't survive volatility. They survive nothing. Even high-profile whales weren't spared. The pseudonymous trader known as Maki Brother was fully liquidated across positions. Losses estimated north of $120 million. And yes, even wallets linked to Changpeng Zhao were reportedly down millions during the cascade. Leverage does not care who you are. Geographically, the pressure points were predictable. Asia accounted for more than 60% of liquidation volume, with high leverage trading cultures in South Korea and VPN-routed activity from China amplifying the scale. In the U.S., institutional flows move differently. Less forced liquidation, more hedging, more positioning. Coinbase Pro saw institutional risk reduction, not panic. This wasn't symmetric pain. 3 factors stacked perfectly and disastrously. First, leverage overload. Open interest was elevated, futures positioning was crowded, and too many traders were leaning the same way. Second, thin weekend liquidity. Small moves became big moves. Big moves triggered margin calls. Margin calls became forced selling. Third, macro triggers. Tariff headlines, shutdown fears, and broader risk-off sentiment gave algorithms the green light to de-risk aggressively. Once prices crossed liquidation thresholds, the system fed itself. Selling caused liquidations. Liquidations caused more selling. That's not panic. That's feedback loop failure. Now, who benefited from all this? Because as usual, someone always does. While retail leverage was getting vaporized, smart money was hedged. Large funds, including those aligned with ETF issuers like BlackRock, were either protected or selectively buying into the chaos. This is the quiet truth of liquidation events. Retail pays tuition. Institutions manage risk. Liquidity changes hands. So, where things stand now? By February 1st, daily liquidations cooled to around $500 million, still elevated, but no longer apocalyptic. Leverage across the market is now down roughly 20%, which is actually constructive. However, futures open interest remains high, around $30 billion. That means another 5 to 10% drop could still trigger another $1 billion in liquidations if momentum turns again. The system is calmer, but it's not healed. This wasn't just a bad weekend. It was a leverage purge. Events like this don't kill bull markets, they reset them. Weak hands are gone. Positions are cleaner. Risk gets repriced honestly. And while it feels brutal in real time, these moments are often what make the next leg possible, assuming macro conditions don't deteriorate further. The market didn't fail. It flushed excess. When we come back, we'll zoom out again, away from crypto-specific mechanics, and look at the macro pressures that made this market so fragile in the first place. That's next. Stay with us.
She redefined what it meant to race without limits. She proved that silence could be louder than words. Fearless, fast, focused. A reminder that champions are built on grit. That same intensity now fuels her signature blend. Roosted and roasted. Bold Italian roast crafted with the spirit of champions. Ashley's Roosted and Roasted, only at wholeshotcoffee.com.
All right, welcome back. So far, we've talked about price breaking, then leverage snapping. Now we need to talk about why markets were so fragile to begin with. Because crypto didn't sell off in a vacuum, it sold off inside a rapidly shifting macro environment. Over the past week, 3 macro forces collided almost simultaneously. Tariffs, monetary policy uncertainty, and rising geopolitical tension. Each one alone creates friction. Together, they flip markets into risk-off mode. First, tariffs. Donald Trump's administration reignited aggressive tariff rhetoric, including 10 to 25% threats aimed at European partners and South Korea. One flashpoint involved Greenland, and by extension Europe, where tariff pressure was framed as leverage tied to Arctic resources and strategic positioning. European leaders pushed back hard. Mette Frederiksen publicly rejected U.S. pressure outright. Markets heard one thing very clearly. Trade friction is no longer hypothetical. And when tariffs come back, global growth assumptions get repriced. At the same time, speculation around the next Federal Reserve chair intensified. One name circulating heavily, Kevin Warsh, widely viewed as hawkish. Even rumors of a tighter Fed posture matter. Higher for longer rates, strengthen the dollar, compress liquidity, and pressure speculative assets first. Crypto lives downstream from liquidity. When liquidity tightens, crypto feels it before fundamentals ever matter. Then came geopolitics. Rising U.S.-Iran tensions, including proxy activity and military signaling, added another layer of uncertainty. You don't need escalation for markets to react. You just need unpredictability. And when unpredictability rises, capital does one thing consistently. It looks for safety. And that's exactly what happened. Gold surged, up more than 5%, hitting record highs. Risk assets sold. Equity slipped. Crypto fell harder. Bitcoin's correlation with equities, roughly 0.6, meant it didn't behave like digital gold. It behaved like a high beta risk asset. This is where the Buy America narrative started circulating, capital diversifying away from US-centric risk. But here's the nuance. The dollar weakened in spots, yet liquidity still tightened. That's the worst combination for crypto. Crypto didn't fall because its thesis broke. It fell because tariffs threaten growth, hawkish Fed, speculation threatens liquidity, and geopolitics threatens stability. And crypto sits at the intersection of all three. By the time Bitcoin cracked, nearly 70% of supply was in profit, making profit-taking rational, not emotional. This wasn't fear, it was repricing. So, what comes next? Short term, the risk remains. If tariff threats formalize, whispers point to mid-February deadlines, Bitcoin could test the low 70s. Watch the dollar index. Above 105 keeps pressure on risk assets. Below it, opens room for relief. On the flip side, trade de-escalation, clear Fed messaging, or diplomatic cooling. Any of those could trigger a 10 to 15% relief rally across risk assets. Markets don't need good news. They just need less bad news. So, this sell-off wasn't just crypto misbehaving. It was crypto reacting correctly to a macro environment that suddenly got louder, sharper, and less predictable. When policy uncertainty rises, liquidity tightens. When liquidity tightens, leverage breaks. And when leverage breaks, everything accelerates. That's not chaos. That's the system doing what it's designed to do. When we come back, we'll narrow the focus again, this time to Washington itself, and how a partial U.S. government shutdown added yet another layer of volatility to already nervous markets. Stay with us.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, welcome back. If tariffs, Fed speculation, and geopolitics weakened the floor under markets, this next development shook confidence in the room itself. The United States just entered a partial government shutdown, and markets noticed. Congress failed to pass a funding bill by the January 31st deadline, triggering a partial shutdown that took effect February 1st. Non-essential government operations halted. Roughly 800,000 federal workers were affected, and key agencies slowed or stopped routine functions. Emergency talks are underway, with a February 2nd vote expected. But in markets, timing matters, and this hit at the worst possible moment. At the center is a divided Congress, with spending cuts pushed by Republicans and resistance from Democrats seeking to preserve aid and discretionary funding. United States Congress couldn't bridge the gap in time. Donald Trump added pressure through veto threats, hardening negotiating positions. And agencies that matter to markets, including the Treasury and the SEC, found their operations constrained. Not frozen, but slowed enough to matter. Government shutdowns don't usually crash markets on their own, but they compound uncertainty. A shutdown raises immediate questions. Will fiscal stimulus be delayed? Will economic data releases pause? Will regulatory decisions stall? For crypto markets, already under stress, this matters disproportionately. Liquidity is partly psychological, confidence is partly institutional, and a shutdown signals policy gridlock at the exact moment markets want clarity. And how did the market react? Well, we all know the answer to that question. Risk assets slipped further. Bitcoin, Ethereum, and XRP all saw additional downside pressure as traders layered political risk on top of macro risk. This wasn't panic selling, it was position trimming. Traders weren't betting on disaster, they were stepping back until the fog cleared. Crypto firms felt indirect pressure too. Regulatory engagement slowed, lobbying timelines stretched, and uncertainty crept into an already crowded narrative. So why does this matter for crypto specifically? Crypto lives downstream from liquidity, policy clarity, and market confidence. A shutdown doesn't remove liquidity directly, but it delays decisions that affect liquidity expectations. When markets can't model what Washington will do next, they reduce exposure. Crypto, again, feels this first. Most analysts expect a quick resolution. Odds favor a deal within days, with the February 2nd vote seen as the likely off-ramp. If that happens, market damage stays contained. But history matters. The 2018 shutdown lasted 35 days. If this drags, sentiment deteriorates, volatility stays elevated, and Bitcoin risks slipping below 75,000. On the flip side, resolution unlocks relief. Markets don't celebrate competence, but they do exhale when chaos ends. This shutdown didn't cause the sell-off, but it removed reassurance at a moment markets desperately needed it. In stressed systems, uncertainty is fuel, and right now, every unresolved question adds weight to the downside. Markets aren't asking for perfection, they're asking for predictability. When we come back, we'll turn to the regulatory front, where predictability is also in short supply, as the Clarity Act stalls deeper and the White House finds itself brokering a growing standoff between banks and crypto. That's next, after this.
Monday morning starts here. Coffee in hand, ready for the grind. Leaving the bike behind, chasing the week ahead. Fueled by the passion to ride and the coffee that gets us there. Whole Shot Coffee. Fuel your life.
And we are back, boys and girls. After price breaks, liquidations, macro shocks, and political gridlock, we end the news block with the issue that's been hanging over crypto for years: regulatory clarity. Or more accurately, the continued absence of it. The Clarity Act, the bill designed to finally define how digital assets are regulated in the United States, is now stalled deeper than before. The original markup was scheduled for January 15th. It was postponed, then postponed again. As of now, there is no new markup date. While the Senate Agriculture Committee passed partial language on January 28th, the full bill remains stuck and unresolved as we move into February. At the center of this effort is the White House. David Sachs has been quietly brokering talks between banks, lawmakers, and crypto executives in an attempt to bridge widening gaps. Those meetings, held January 28th, focused on three flashpoints: stablecoins, tokenized equities, and decentralized finance. And on all three, there's friction. Let's start with stablecoins. One proposal would ban yield on idle stablecoin holdings, effectively protecting banks from competition on deposits. Crypto companies argue this kneecaps innovation. Coinbase has been vocal, calling portions of the bill dangerous and accusing lawmakers of favoring legacy banking interests. That tension spilled into public view when Coinbase effectively withdrew support. On the other side, banking lobbies, including groups like the American Bankers Association, are pushing hard against yield-bearing stablecoins, tokenized equities, and open DeFi rails that bypass intermediaries. From their perspective, this isn't regulation, it's competition control. Not all crypto firms agree. Companies like Ripple, represented by Brad Garlinghouse, have signaled more openness to compromise, prioritizing some clarity over continued ambiguity. This has fractured the industry's unified front, weakening its leverage in negotiations. Timing matters. Markets are already fragile. Macro pressure is high, liquidity is tight, and confidence is shaken. In that environment, uncertain rules cap recoveries. Investors don't need perfect regulation, they need predictable regulation. And right now, the Clarity Act has become a symbol of Washington's inability to decide whether crypto is a threat, a competitor, or an asset class worth integrating. So, what happens next? There are two paths forward. The optimistic path, where a revised markup emerges in late February. Compromises narrow the amendment count, and the bill clears Q1 with bipartisan support. That outcome could spark double-digit rallies in altcoins and unlock sideline capital. The pessimistic path is one where talks drag into mid-year, amendments pile up, more than 137 by some counts, and the bill stalls into election season. That doesn't crash markets, but it caps upside. Uncertainty becomes gravity. So, what's the key takeaway here? Crypto isn't asking Washington for favors. It's asking for rules that make sense, apply evenly, and don't freeze innovation to protect incumbents. Right now, the Clarity Act isn't failing because of ideology. It's failing because too many interests are pulling it in opposite directions. And until that's resolved, markets will keep pricing in hesitation. When we come back, we'll turn it over to you, diving into the Proof-of-Thought Mailbag, where the community reacts to this week's volatility, policy gridlock, and what it all means going forward. Stay with us.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, welcome back. We've covered crashes, liquidations, tariffs, shutdowns, and stalled legislation. So now it's time to hear from the people who experienced all of that emotionally. Let's open the Proof-of-Thought Mailbag. Submission number 1 is from @BuyTheDipAgain. Username checks out already. They write, is this just another shakeout before the next leg up, or is this the start of a deeper bear market? Ah, yes, crypto's most timeless question. Here's the honest answer. It's always a shakeout, until it isn't. This was a leverage purge. That part is factual. But macro pressure hasn't resolved yet, and regulation is still playing musical chairs. So if your strategy is buy every dip blindly, just understand, sometimes the dip has stairs. Next one is from @100 times or bust. First of all, thank you for your contribution to market liquidity. They say, liquidations are just manipulation. Exchanges hunt stops and screw retail. Look, exchanges are ruthless, but no one forced you to run 100 times leverage on a weekend with low liquidity and macro headlines flying around. That's not manipulation. That's voluntary skydiving without a parachute. Markets didn't target you. Math did. Submission number 3 is from @macroisfake. Strong thesis right out of the gate. They write, crypto shouldn't care about tariffs or shutdowns. This is supposed to be decentralized. In theory, sure. In reality, crypto trades like a risk asset with a caffeine addiction. Liquidity still comes from the same global system. Rates still matter. And when macro sneezes, crypto catches pneumonia. Decentralization doesn't make you immune to capital flows. It just makes the charts prettier. Next one is from @StablecoinSteve. They ask, why are banks so scared of stablecoins paying yield? Because yield is competition. Banks don't hate innovation. They hate disintermediation. A stablecoin that pays yield without requiring a checking account, minimum balances, or overdraft fees, that's not a threat. That's a bank replacement in beta. So yes, expect resistance. A lot of it. Submission number 5 is from @SenIsRightAgain. No comment. Seriously, they said it, not me. Okay, they write, this feels like 2021 all over again. Same patterns, same mistakes. You're not wrong. Every cycle, too much leverage, too much certainty, too little humility. Then the market humbles everyone simultaneously. Crypto doesn't repeat exactly, but it rhymes aggressively. All right, next one is from @IJustWantedCoffee. Finally, a grounded individual. They say, I don't trade. I just watch the show and drink coffee. Is that okay? That's not just okay. That might be the highest IQ strategy submitted today. No leverage, no panic, just caffeine and context. Much respect, mi amigo. So, here's the pattern across every submission. Fear wants certainty. Markets don't offer it. What they do offer are signals. Leverage flushed, risk repriced, policy unresolved, and macro loud. That doesn't mean run. It means think. And ideally, don't 100 times anything on a Sunday. When we come back, we'll round out the show with a SENB Project update, what we're building, what's coming next, and why none of this chaos changes the long game. Stay with us.
On the track, she raced with heart, grit, and number 67 on her back. And now, that same passion fuels something new. Espresso number 67, bold, smooth, unforgettable. The day ends, the dust settles. Bold enough for the ride, smooth enough for the night. Espresso number 67. Available now at wholeshotcoffee.com/Ashley.
All right, welcome back. Before we close today, I want to talk about what we've been building and why there hasn't been a daily brief for a few days. Not because anything was wrong, but because I was busy doing the work. Over the past 2 weeks, I was working the Sundance Film Festival across logistics, coordination, and on-the-ground problem-solving tied to the Heretic Films Lounge. That environment matters. It put me in direct conversation with people in entertainment, people adjacent to media, and people adjacent to funding, production, and distribution. And the common thread in those conversations was simple. Everyone is looking for independent infrastructure, not platforms chasing ads, not creators owned by algorithms, but systems where value flows back to the people who create it, which made talking about SENB Media feel natural. Contact info was exchanged, coffee samples were handed out, and SENB Media project cards were shared directly to phones, the modern version of a business card. More importantly, there was consistent, let's continue this conversation energy. That matters more than likes, more than charts, more than short-term price movement. This project was built for alignment, not virality. Now, let's address the obvious. The market just went through a violent weekend. And while we don't focus on price, especially at this stage, we do look at behavior. SENB held together, liquidity stayed intact, participation remained steady, and there was no panic cascade. For a young project, launched November 7th, that's not nothing. It tells us the community understands the difference between noise and structure. Participation continues to grow where it actually counts. Right now, approximately 45 million SENB tokens are staked, and roughly 12,375 SENBT are being distributed daily. That's not speculative churn. That's long-term alignment. People aren't here to flip a candle. They're here to own a piece of the network. On the creative side, momentum is strong. Paul has been hard at work refining and remixing earlier material. We now have enough finished tracks for the next album, additional singles queued, and material for a remix album as well. The next full release, Road to Freedom by Ember Vale, is coming soon. This isn't filler content. It's part of the broader thesis. Media that stands on its own, then gets amplified by the network, not the other way around. The airdrop is still on schedule. Final mechanics are being tightened, deliberately, not rushed. We're also adding new items to the roadmap, which we'll announce when they're ready. No vague promises, no premature reveals. If we say it, it's because it's built or building. In a week where leverage collapsed, policy stalled, and markets reminded everyone who's actually in control, SENB kept doing exactly what it was designed to do. Build quietly, align incentives, reward participation, and grow without depending on hype cycles. That's not accidental. That's architecture. And with that, let's close this out, because after a week like this, perspective matters more than predictions. My final thoughts are coming up next after this.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
Before we wrap up, let's zoom out one last time. What you just lived through wasn't chaos. It was stress revealing structure. Markets don't break randomly. They break where assumptions pile up faster than reality can support them. Leverage gets exposed. Liquidity disappears. Narratives that sounded convincing a week ago suddenly go very quiet. And that's uncomfortable, but it's also useful because stress tells you what's real. Real conviction doesn't need constant reassurance. Real builders don't vanish during drawdowns, and real systems don't depend on perfect conditions to function. They keep moving, slowly, deliberately, while everyone else argues about candles. If you're feeling shaken, that doesn't mean you're wrong. It means you're paying attention. The mistake isn't fear. The mistake is letting fear talk you into decisions you didn't believe in last week. This market will stabilize. Policy will eventually clarify, and narratives will rotate again. They always do. But the people who come out stronger aren't the ones who guessed the bottom. They're the ones who understood what actually mattered while everyone else was distracted. That's where we'll keep operating. No hype, no panic, no performance. Just logic, alignment, and building things that don't disappear when conditions get hard. That's it for today's Daily Brief. If you're still here, you're doing fine. We'll be back tomorrow to check in on you. Until then, have a good one. The SENB Daily Brief is a production of SENB Hero Media in collaboration with Whole Shot Coffee, coffee that fuels champions. Written and hosted by yours truly, SENB Hero. Production, editing, and scheduling handled by Maya Valencia, who somehow keeps me on time, caffeinated, and occasionally polite. Original theme music composed and produced by Paul Hahn, the community legend whose beats hit harder than a Fed rate hike. Research support provided by the SENB community. Proof that sarcasm and spreadsheets can coexist. For more shows, merch, and on-chain chaos, visit SENBHeroMedia.com. Thanks for tuning in. Stay caffeinated. And remember, if it's not in the brief, it probably wasn't bullish anyway.
Set my wallet free.